Hey everyone, welcome. It's great to see you on this terrific Monday morning, 6 a.m., half an hour before the morning, or sorry, I guess the morning session is going to start. I'm finally back. I'm back for at least till June, as far as I know. I could be wrong that something else could come back into my schedule in between now and then, but for now, I am here and it's great to be here and to focus on the markets with you guys. So let's take a look at how the world is looking this morning after the weekend. We'll take a quick overview of the markets since we were able to do it yesterday for the weekly market review. We can see here that the S&P 500 broke down pretty hard on last week. However, it was nothing extreme. It was very orderly, nothing that is out of the ordinary, or we would say breaks normal market rhythms. This is exactly in line with things that we've been talking about for a few months now. It just took a while for the things that we are seeing in the markets to actually develop. So at this point, we've pulled back. We've broken our MA50, we've broken our uptrend line, and we are in a phase where the market is pointing downwards. That doesn't mean we're in a bear market, but it does mean that we are at the very least having a pullback. And we were talking about last week how it is more likely that this is going to go in the correction territory, meaning that we are going to fall at least or in the region of 10%. That is not a super precise number. It could be 9, it could be 10, it could be 11, it could be as high as 15 before we start getting concerned about it becoming a bear market. So for now, this is just looking like so far we've had a pullback, and like the likely probabilities are that it will actually develop into a correction. And that would simply look like this right here. We had a bull run, and then we had a correction, and then we had a bull run. So normal market patterns are we run or we move, we rest, then we test either to the upside or downside, and then we move again. So right now we had our move, we had a rest, and then we tested and broke to the downside, and now we're starting to move again. And we're moving in the opposite direction in this case. And for now, we're not expecting it to move beyond correction territory. And for now, we're also not going to expect it to stay within pullback territory. So when I look at this market right now, where did we pull back to? We pulled back to this MA90, maybe slightly below that MA90. If we look over here, we're at our -2 ATR. We've been following it all week long. We basically fell immediately to the -2 ATR and followed it down. Now, sometimes when we follow Keltner channels, it can go for a little while. So we could get concerned that, hey, maybe this might keep on going down all the way to the -10 region and give us our correction. However, we can see that on a monthly level that we're deviating pretty far from that average, that 10-month average right there, and we have pulled back to our EMA 100. So right now, if nothing else was happening in the world, we didn't have the geopolitics and all of this, we would say bounce. Time for a bounce. We pulled back a little over 5%. Let's measure that move. Okay, we've pulled back 5.7-ish%, maybe 5.75. The precise tail is not that significant, but we pulled a little over 5%. It's a good place to bounce. So what are we seeing this morning? Is take a look at our futures and see if it's telling a similar story. Where are my futures? There we go. Okay, and we're up. So it does look like we're bouncing. We've got the S&P 500 at roughly 60 basis points, our NASDAQ at almost 70 basis points, and our Dow at a little over 50 basis points. So this is not random. It is significantly up. However, we've got to take this with a grain of salt because many times last week, or actually basically the entire last week, we started up in the futures and we ended down. Every single one of these is a red bar with a low lower than the previous low. Yes, a low lower than the previous low and a close lower than the previous close. So just because we're up, normally we would say that the amounts that were up are non-random and it would be difficult, it'd be more likely than not that we would be unable to overcome the morning move so that we would actually end higher. We wouldn't necessarily end 50 to 60 or 70 basis points higher like we started, but we are likely to just end higher, meaning that maybe just 10 basis points higher or 5 basis points higher or 20 basis points higher or maybe 150 basis points higher, just that it was more likely to end higher than the previous day close. But all week last week, we broke that. So we're not going to get too excited that these futures are up here in non-random territory. It's just a sign that maybe we bounce. At least we have an intraday bounce. So we want to see where do we think we can get if we get a bounce today, if we finally get a green bar at the very least. And you can see that in the pre-market, in the pre-market, we are up here towards the territory where we opened in the previous session on Friday. And again, that doesn't necessarily mean much. So for example, this day we opened above the previous day open and we actually opened maybe right just below the previous day high, but we still traded downwards. Now, this has been a big move and it's been a week-long move. If we look at this on a weekly basis, this is going to be a giant red bar. So that's a huge move, and actually it's a giant red bar into a significant level in the EMA 20 on the weekly chart. So there's a lot of support right here. It's unlikely that we're going to bust straight down through support without a catalyst. If we leave the market to its normal rhythm, it should bounce from here. The question is how far, how long? We talked about how it's very unlikely to go straight back up. But even if it did, it's really unlikely to just start making a new high right here. So we are almost assuredly in a downtrend, not a bear market, but a downtrend. And we do need a bounce before we come back down. What are good places to bounce? Well, if the market is really weak, then we'll bounce off somewhere like a EMA 8. If it's a little bit stronger, the EMA 20 and the MA 50 are at the same level right now, and that would actually be a really great place to bounce. However, if we're looking at the shorter term, where can we bounce from? The purple line right here. This 500 line that we said, hey, it might have acted as a support. It sort of did for a couple of days, and then we came down. So let's take a look at what that looks like on a intraday level. On the S&P 500, let's find 500. Let's find that 500. There we go. Again, it's not super precise. These are regions that we talk about. And we can see that on this day, which was Wednesday, we came to roughly the 500 level. We came a little below it, but again, these are regions. So we came and we reacted to the 500. The next day, we bounced off to 500 and we chopped around very close to the 500. And then on Friday, we bounced off of that 500 again. So every time we came to the 500 region, there was a lot of trading. There was a lot of money and shares exchanging hands. So if we add up all the volume around near the 500, just call it 499 to 500 level, then we would see a spike. If we drew a volume profile, we would see a spike over here at 500. So on a shorter term basis, that 500 level is acting as a psychological point. And normally large round numbers like this do serve as a psychological point. So if we rally, we could get paused at 500. Now that's a little close. So it's not too likely that we'll just get stopped right here and come back down. So what's the next level? What's the next level beyond that? Well, if we look on this chart, we would look at the EMA 8. That's the first level we talked about a little bit earlier. The EMA 8 is currently at 504.26. And if I look on my daily chart, well, we already have a line at 505. And again, we talk about regions, not precise lines. So this 505 level, we drew it for a reason. It must mean that we reacted to it quite a bit. And this entire day, even though this is a larger region, we can see that we chopped around near that 505. We chopped around the end of this session around 505. And that's probably it for a while. And yes, so today or the next few days, if we're going to be in the bullish direction, what we want to see is that we come up and we test. Remember, what do markets do? They move, they rest, they test, then they move. So we want to see the test of 500. And if we pass that test, then we move to 505. If we fail that test, then we come down and we match previous lows, and that's going to be a new test to the downside. So over the next few days, we're going to watch 500 and 494 carefully. If we break down, then that is probably going to mean that we're going straight down to our minus 10%-ish region correction. If we test upwards and pass, then we should move towards the 505. And 505 is our EMA 8. And we did have a secondary spike in our volume profile over here. Actually, it might be even the major spike just because of how the entire day traded in that region. So that's what we're looking at the S&P 500. We came down. We're at a heavy support level. Likelihood suggests that we're going to move upwards to that EMA 8. And we're not going to be surprised at all if that's the place that we bounce down from and we continue a correction. If not there, then the MA50 and the EMA20, which are currently at 510.44 and 509.93, we'll call that the 510 region. So let's look over here on the levels we've drawn in the past, and you can see that we have spanning the 510 region, we have 508.50 and 512.02. So this is a giant region right here from just call it 509 to 512. 509 to 512. It's going to be very difficult once we hit that level. If we manage to get past 505, it's going to be difficult to get past just call it 510. So what we're looking at in terms of high probability, absent of outside influence on the market, is a bounce from here up to either 505 or 510. Now, what could change that? What could change that is, you might think, geopolitical risk, but really the effects of completely outside market forces is always very limited, and it only has a few hours or at most a few days, unless that force becomes persistent. For example, during COVID, government intervention in the markets was persistent. They told us we were going to shut down for 2 weeks. Then they told us we were going to shut down for a month. Then it became another month. Then it became another month. Then it became a year. Then it became 2 years. That was an extreme and persistent outside force that had an effect on the market. But notice it didn't have an effect on the market for 2 years. It had an effect on the market for just a few months. From February to the bottom, that was only March, and up to here to June before we got to similar levels and we had normal market rhythms again. So from February to June, 4 months, 2 year persistent outside force had a effect on the market for only 4 months. So extended war in Ukraine for over 2 years now, market effect, it was only like a day. So we're not going to be too concerned about geopolitical forces or war or anything like that because it's not going to have a long-term effect. So what could be a stimulus that might change some of this? Well, the ones that we have in the market right now, so are Fed and their monetary policy. That is a persistent effect of the government on the markets. Similar to COVID, but not nearly as extreme because we have a history of the governments intervening with monetary policy, and we have studies of governments intervening with monetary policy. So they become more predictable and they become priced into the markets, which is why we can have things like the FedWatch tool that tells us and calculates for us the probabilities of certain things happening, like rate hikes. I don't know why this isn't loading up, and I'm not going to spend too much time on it. So the market forces that we want to look at for are anything that have to do with Fed. And then something that is much more internal to the market is earnings. So let's take a look at our calendar. And this week we have PMI, that's going to be very important. We have GDP, that's going to be very important. We have personal income and outlays. Basically, this is the Fed's preferred method of measuring inflation. So we could have some Fed action. We can have some Fed, or at least some data that suggests what the Fed's next move is going to be. So that could be a stimulus in the market. I wish we had that FedWatch tool so we could see, because in May 1st, which is only a couple of weeks away, the Fed is going to announce whether or not they're going to change the rates. Everyone always talks about rate cuts. That's only in the current environment. They actually announce, are we going to keep it the same? Are we going to raise it? Or are we going to lower it? And normally they do it in small baby amounts, 25 basis points at a time. But when the Fed started to fight inflation a couple of years ago because they said, oops, we kept insisting that inflation was temporary, that it was transitory was the exact word. And we messed up. It's a lot stickier than we thought. And they started hiking at 50 basis points at a time. That was unprecedented. That was something that had never happened. So this could affect, and we have earnings. Earnings are really starting to pick up. I don't want to spend too much time because we're getting closer to the market open. And I did over the weekend look at earnings, and we have some pretty major players. We have Tesla, we have Google, we have Intel, we have Meta. We have many, many companies. I think it was around a few hundred reporting over this week. So that the quality of those earnings will have an effect on the market direction. So what are we going to look for? What are the signs? Well, S&P 500, the important levels are did we say 494? 494 level, the 505, and the 510. We're going to look at those very carefully. We are going to look at the VIX, the volatility. If we start spiking above this high right here, on Thursday, we had a huge spike. If we get above this 2130, Okay, so that maybe that might be too precise for volatility. We'll say like 21 and a half, 21.75. Why? Because we have a whole bunch of earnings, and earnings does generate volatility. So it is natural for volatility to rise during this time period. So we'll give it a little bit of wiggle room. So if we start going up above 21.50, 21.75, maybe 22, then we're going to be concerned about moving straight down into that 10% correction territory. If we break below 1690, so the bottom of this green bar or the open of this green bar right here, then these markets are going to look a lot more calm, or maybe 1650. And we're going to be more enthusiastic about we'll call it a longer or slower, steadier recovery to the upwards side, or it should be recovery, it should be a pullback to the upside. And then we want to look very carefully. If that happens, then we may move through the EMA 8, and then we'll have to look very carefully at this EMA 20 and MA 50 level. We'll also want to take a look at bonds. Bonds, you can see it spiked below this line right here, the support level of our channel, and move back upwards. And if this can slowly move back upwards to the EMA 20 or this horizontal line, that's going to relieve pressure in the QQQ, and it could recover because the QQQ took it hard. It came down. This is parabolic movement downwards and into basically no man's land if we look in terms of moving averages, but there is a horizontal support near here. We didn't quite, well, we hit the very top of that region with the low on Friday. So that would allow the QQQ to recover some, maybe get all the way back to its EMA 8 or EMA 20 before our expectation is still the same as the S&P, that we would bounce back and resume our downtrend. So you can see that on the QQQ, I'll be very surprised if this is not well beyond 5%. Yeah, we're already at 8%. So QQQ is already telling us that, hey, we're probably hitting that 10 to 15% region in the QQQ. And if we're going to do that, then the S&P is going to be dragged along with it. So 10% would be that MA50. The MA200 is 11.75%. So that is well within our correction territory. So QQQ is already telling us we're most likely going down to that correction territory. Well, QQQ is already pretty much there, but we're probably going to bounce up and then come back down before we get to those levels. Okay, so that's what we're looking at this week. We're just going to watch how quickly how quickly the markets move to the levels that we mentioned, the EMA 8, the EMA 20s, the 505, the 510, or do we break straight down below the 494 level? And does it take a day? Does it take all week? Either way, I would probably, if you are trading during the day, you could take some longs right here, some short-term longs into the EMA 8 or MA 50, EMA 20 if you see that the market moves smoothly through the EMA 8. And then when we get to the resistance levels at 505, 510, we start to move to the downside. If you're swing trading, if you're not trading during the day, then you would just wait. Hey, we're at the EMA 8. Did we move well through it? And if not, then let's take some short positions. If we do, then we wait until the MA 50, EMA 8, that 510 level, and then we initiate some short positions, but we don't want to go completely short in case we do pop our heads above this, in which case those all-time highs would be a very good place to place a short. So we have a good roadmap for the week. We'll go into a more narrow view day by day as we get there. So tomorrow we'll just focus more on a 1 or 2 day view rather than the entire week view. But we have a good template for us to analyze the rest of the week. We are 5 minutes away from the market open, so we'll leave you here to prepare. Have a wonderful day, and I will see you in the aftermarket session.